In this video, we're going to walk through a problem involving a financing lease from the lessee's perspective. Assume that IBM leased equipment that was being carried at a cost of $120,000 to Sharon Swandler Company. The term of the lease is 6 years, beginning January 1, 2020, with equal rental payments of $28,430 due at the beginning of each year. All executory costs will be paid by Swandler directly to third parties. The fair value of the equipment at the inception of the lease is $145,000. The equipment has a useful life of 6 years with no residual value. The lease has an implicit interest rate of 7%. There's no bargain purchase option and no transfer of title. And collectability is reasonably assured with no additional cost to be incurred by IBM. Why is this a financing lease? First, the lease term is equal to 75% or more of the estimated economic life of the leased property. The lease term is for 6 years, and the equipment has a useful life of 6 years with no residual value. Second, the present value of the minimum lease payments, which we could calculate as $145,000, is greater than 90% of the fair market value of the leased property, which we are told at the inception of the lease is $145,000. What type of financing lease is this from the lessor's perspective? From the lessor's perspective, this would be considered a sales type lease, and IBM will record a lease receivable, sales revenue, as well as cost of goods sold, and remove the inventory from its books. A financing lease should be recorded by the lessee and lessor as an asset and a liability at the lower of either the fair market value or the present value of minimum lease payments. In this case, both are the same. If we calculate the present value of the future minimum lease payments, we get $145,000, and we're told the fair value of the equipment is $145,000. Let's go ahead and look at the journal entries that Swandler will record on January 1, 2020 at the inception of the lease and entries during the first year. On January 1, Swandler is going to want to record a rights of use asset and a lease liability equal to the minimum of the fair market value or the present value of minimum lease payments. We already decided they were the same, but let's look and see how we would figure that out. We're given an implicit interest rate of 7%, and we have a payment of $28,430 per year for 6 periods. We would calculate the present value, again, by taking a present value annuity factor and multiplying it by the lease payment. Or we could solve for it with our financial calculator, making sure we have our setting as an annuity due. It's for 6 periods, a 7% interest rate. The cash flows of the payments are $28,430, and in this case the future value is 0 because we had no residual value. And we would solve for the present value, which is $145,000. So we debit the rights of use asset for $145,000 and credit the lease liability for $145,000. We're making our first payment at the inception of the lease, and so we will record a reduction in our lease liability of $28,430 and, of course, a credit to cash of $28,430. Every time we make a lease payment, we reduce the liability by the amount of the payment. On December 31st, we're going to need to record interest expense. And we will debit interest expense and credit the lease liability. Again, we're not making a payment until January 1st, so we're going to need to record both the interest expense and an increase in the lease liability. We will then reduce this liability when we make a payment on January 1st. Our time 0 payment included no interest since it was paid at the inception of the lease, and we calculate the change in the principal by taking, of course, the payment minus the interest gives us the change in principal, bringing us down to a lease balance of $116,570 on January 1. Our interest expense at the end of the first period will be $8,160. That's the prior period's balance times our 7% interest rate. We also need to record amortization expense at this point in time of $24,167. That's the rights of use asset of $145,000 spread over a 6-year period. We debit amortization expense and, of course, credit the rights of use asset. Normally we would credit accumulated depreciation, but typically we do not record accumulated amortization on a rights of use asset. We directly reduce the asset. When we make our journal entry on January 1, 2020, we will credit our lease liability and, of course, debit the lease liability and credit cash. The same entry we make every time we record a lease payment. Let's take a look at our journal entries for December 31st, 2021 to record interest and amortization, as well as our next lease payment on January 1, 2020. On December 31st, we're going to have interest expense of $6,741. That again is from our amortization table. It's our initial lease balance of $145,000 minus the first principal payment, as well as the second portion of the principal. And of course, we credit the lease liability and we record our amortization expense, which was the $145,000 spread over the 6-year lease life. When we make our January 1, 2022 lease payment, we'll of course debit the lease liability and credit cash for the amount of the payment.